The Grand Hyatt Hotel in San Francisco's Union Square. Several hundred certified public accountants from around the nation have gathered for the CPA Educational Foundation Conference.
Good afternoon, ladies and gentlemen. It's a pleasure to be here, and I feel honored to be in front of this group to have the opportunity to explain some of the issues that we see on a daily basis concerning long-term care in the context of estate and income tax planning. Approximately 6 years ago, I spoke on this same subject before this audience, and at that time, we had not produced the publication you have in front of you. I've been gratified and very surprised at the acceptance of this book, and in some industry association meetings, it's been referred to as a Bible of the industry. The reason that we're speaking about this issue so frequently and so fervently today is that many people just do not understand that they're not protected by their existing medical insurance policies, and they are not protected by Medicare or Medicaid on the federal level or Medi-Cal on the state of California level. Let me give you an example. This publication here is the rate changes that occurred in the year 2003 with insurance companies approved by the Department of Insurance for increase. Increases throughout the United States are now averaging, with some companies, between 25 and 40%. Not every year, but increases are being approved pretty much across the board. One company raised their rates 600% in 1 year. Now, you've got to pay attention to this issue because it does affect your clients. It is not something that is out of your purview, because if you check with your errors and omissions carriers, especially in the insurance industry, if you are not providing information on this or advising your clients in writing to seek this information, you run the risk of potential litigation in the future. I'm not here to scare people. I'm here to try and protect you from what could very easily happen. The population is getting older. Let me give you an extreme case. Several years ago, a client came into my office. His wife had passed away. He was now 60 years of age. She had contracted an illness called ataxia a year and a half before. In the space of a little over a year, she went through $2 million in benefits because she had to be institutionalized in hospitals and skilled nursing facilities during that period of time. He had no choice in the matter. Fortunately, everything but $100,000 was covered and protected by insurance that he had purchased previously. That's how serious the problem is. Now we're going to see how this works. What you see here are pages from the book itself. At the bottom you can see page 1-2. That is chapter 1, page 2. The reason that I want you to look at the pages in the book is that it's hard to read some of this information. We are saying in a random population of 2,000 people, roughly 500, the bar on the far left, will need long-term care coverage during their lifetime as compared to the need for those with fire insurance for their homes and car insurance for their cars. In other words, will you have an accident during your lifetime? Will your home burn to the ground? Will you have a long-term care event? And how serious will that be, and what is the likelihood? On that same page, you can see this example. Many times I have clients who say to me, I'll worry about this when I get into my 60s. And I fully understand that. But when I'm saying this and having that conversation, their children are sitting there almost smirking. Why are we even talking about this? It doesn't mean anything to me as a child. The child I'm talking about is roughly 20 to 35 years of age, there to help the parents. And I say to the children, Do you know who the second largest consumer of long-term care benefits is in the population? They assume somebody in their 50s, in their early 60s. It is the group 20 to 35 because they do 5 things. They do drugs, they smoke, they drive, they get involved in car accidents, extreme sports, or they do more than one of those at the same time, and they become paraplegics. And they are the biggest consumers of long-term care products and services for the group under 65. So it's a national problem, it's an age-wide problem, it is a world problem. This is page 1-3. All we're trying to address here are issues such as the emotional strain that you can see people deal with long-term care, even if it is not them. How many people in this audience have actually had to deal with a family member, a spouse, a child with these kinds of issues? Could you just raise your hands? You can see as you look around, it's a pretty large proportion. It used to be 10 years ago that it was almost unheard of that anybody was dealing with somebody on these issues, unless it was a very old population. Realize we're getting older, so we're dealing with our children, with our parents and our grandparents, and in some cases our children now. Medicare facts. I could go through this information, but I prefer to just have you look at it. It's also in your syllabus, but it is Chapter 3, page 2. And the one point that I would make to you is the last item here talks about the new study found that the percentage of hip fracture patients remaining in a nursing home 1 year after their hospitalization rose from 9% to 33%. Why is that happening? It is happening because medical insurance policies, whether they are Medicare or whether they are for the working population, specify that you need to stay in a hospital for a minimum of 3 days and then be transferred to a skilled nursing facility to qualify for skilled care. Very important distinction. The hospitals are intent on getting you out of the hospital as quickly as possible. And I mean this as no insult, but the HMOs are just as bad as the regular PPO programs. The problem is skilled nursing care represents roughly 1% of all of the long-term care expenses in this country today. If it's not skilled care, who is paying for it? You and I are paying for it out of our pockets until we drain our assets and resources down so that Medi-Cal and Medicaid then step in, and then we have a very, very serious problem. So it not only applies to this audience, it applies to everyone you know. It applies to your clients. And as I said a moment ago, you need to address this issue. If you're not going to deal with it with your clients, by all means get a trusted advisor to work with you locally who understands these issues. The speakers before are talking about very real sets of circumstances. I have seen claims in the $500,000 to $1 million range that have occurred in a very short period of time. Again, I'm not trying to use scare tactics. I just want you to deal with this issue before it becomes a problem. We tried to use national statistics and portray into the future what the cost actually was for the kinds of illnesses that frequently occur and the average amount of time that a person spends in a hospital or a nursing facility or home care. And you can see that the cost can be very dramatic. Again, this is a page out of the book itself. Who pays for long-term care services? As you can see, this information is pretty much self-explanatory. It's going to become more and more common that we are going to pay for this care out of our pockets. The government is doing everything they can to reduce their liability for this. Here in the state of California, there are special policies that have been created in partnership between the state of California and 7 insurance companies, specifically to provide asset protection while at the same time providing long-term care insurance. These policies are pretty much designed for those who have assets of $300,000 to $500,000 up to possibly as much as $2 million. You would think that somebody with $1 million or more would not have this problem, but from the example I gave at the very beginning, you can see that it's a problem that has no financial cap on it. It can be at any level whatsoever. This is a critical area for all of us to understand. The government has said specifically that standard C corporations get the biggest benefit from creating discriminatory, and I want to emphasize that, discriminatory long-term care plans for employees of corporations. Those employees can be the owners, key executives, they can be a special class. There is no problem with discrimination with these because it falls under IRC Section 7702B, which is not in the material, but will be in the near future. And I'm going to digress for a moment. You received this form at the start of the meeting. We have updated this book twice already. We're in the process of updating it again, and we believe by the end of August, the beginning of September, we will have the most recent current information in the book. So if you want a free copy updating the book you've already got, all you need to do is fill out that form and we'll send it to you as soon as it's produced. But this section, IRC Section 7702B, refers to tax-deductible premiums. They are 100% deductible by the corporation. Tax-free benefits, which simply means when the policies are issued, the individuals that have a policy, when benefits are paid, will pay no income tax on those benefits. And the premiums that are paid by the corporation and deducted are not reported on the W-2. As far as this IRC section goes, all benefits paid are reported on Form 1099 LTC. There are specific provisions for reimbursement and indemnity plans. The taxpayer must file a Form 8853 for any benefits that come from an indemnity plan. The daily benefit that is allowed currently is $240 or greater based on actual expenses. The plans are ERISA and COBRA exempt. Just so you know, there are tax-qualified plans and non-tax qualified plans. And we won't get into those today, but in the book we do go into some substance as to what that is all about. Also, as far as S corporations, LLCs, partnerships, and sole proprietorships, 100% of the age-based premiums are deductible for owners. 100% of the entire premium for all employees is deductible. So this is just an example of how it would actually work and what the benefits are. When I spoke earlier about skilled nursing care, I was referring to the fact that you had to fall under certain very specific rules to qualify for benefits. This number right here, I believe, is $114 per day as of the year 2005. This is some of the information that's constantly being updated, and we try to keep this current, but there are so many different provisions that it is difficult. Many times I've had clients ask me whether they should take a 5% simple inflation rider on a long-term care policy or a compound inflation rider. We ran this example out to show the difference. I can tell you that aside from college costs, long-term care is one of the most expensive, fast-growing expenditures that people have today. It is running 7 to 8% on average. In some categories, much higher. Here in the Bay Area, it is not uncommon to hear people spending $7,000 to $8,000 a month for this kind of care in a nursing home. Now, all of us, I would think, well, I'm going to say 99% of us, would prefer to be at home if we had a nursing required event. If you do that, it's even more expensive because you need to bring in services that charge on an hourly basis. Thank you very much.